Welcome to Beginner Trading. Tonight, tonight's class is going to be about bear flags and bear pennants, kind of extending our lesson on rule of three, but on the bear side. We mainly trade on our chat room on the bear side. We're definitely kind of edging into that long and playing both plays. But tonight, we're going to go mainly into the downside and learning more about bear flags and bear pennants. All right, so bear flags and bear pennants. How's the best way to approach them? All right, guys. So when we have bear flags, we're always going to have that downward trending resistance line. All right. And we're also going to have an uptrending support line. And that uptrending support line gets that volume consolidation. And as you see, the consolidation is really what we're getting to. This is not an actual example that works here, but it's what it actually goes on. You're getting that tightening up. And what we're looking for is those three tests of supports, those three tests of key resistance, and then big volume on breakdown. And if it does reverse, we go ahead and we just get on out. All right, we got to pay attention for big sellers on the time and sales. That's what we're looking at the end. We got to jump on their momentum. Their momentum is what we're going to go ahead and jump on to trade. So we look for big sellers to show up on the time and sales. I always talk about little orders followed by big orders. Look for those big orders, and once you see those big orders, that'll show you more confirmation inside your trade. A bear flag is always, if you play it towards a direction, is to be played on the short side. A bull flag would be played towards the direction, would be played on the bull side. You can always play these for what we call trend reversals, which is what happens here. But that's an opposite trend trade. This is more of a kind of what you're going to see common. You're going to see a lot of bear pennants. And bear pennants have that solid support line. You can clearly see this support line. It touches it multiple times down here. You can clearly see the support. The support is one key line there. The key here, you want to see kind of reversals here. It kind of getting bought up at the bottom and then shorted at the top. Big orders going through at the top here. Nice wick action. Rejections. And then a whole dollar support. We know that how that acts when it breaks down. If you get big sellers through this action, through the whole dollar, you generally will get that big move. So generally when it consolidates to the tip of the pennant, it's either going to make a big move and follow a trend or reverse. Clearly, that's exactly what happens, Jason. Sometimes what we'll get is we'll get fake outs. And so you won't get the kind of big move. You'll get kind of a little move, and then it'll come right back inside the pattern. But generally, when we break out of a pattern, we either get that breakout or we get what I call the breakdown, or you kind of get that squeeze on the short side. If this doesn't work, the stock would have ended up here in this area, in this general direction, and kind of making its way back to VWAP. So comparison, bear flags tend to have more resistance above. They have that upward trending line and a downward trending resistance. And so as it tightens up, it has that more resistance above. So it really quickly gets to the resistance, but can't break. So then it has a tendency to get closer and closer to that resistance level. Positive. The positive is that you can protect you. You can use smaller risks because you have an upward trending line and a downward trending line. They're actually making it smaller and smaller risk, but the breakout can be kind of more impactful because of the consolidation and accumulation of volume. The negatives is that it's most common to have a lot of fake outs. You can get kind of wicks past the pattern, and that's why you really got to see volume kind of jump into the trade versus just see the kind of wick action. When we talk about bear pennants have a solid support line. This is what we got to take advantage on bear pennants. The positive is that you know the risk. You know that it should break down that reward there at the support line and give you that next move towards the next support. The negative is that since you have a downward trending line and a solid support that everyone can plain out see, is that when the pattern squeezes, it usually has a tendency to be higher and heavier than in a bear flag. The wheat stocks have a tendency of doing flags common. They're very common in their trading, and when they do it together, like they did today, the whole industry moving in one direction, you can really make some money. You know, there were some laggers like MBEV and APHA, but you got to take advantage. Know the three rule. Start seeing it, and if you're seeing it around, start taking advantage.
For sure.
All right, guys. So let's start getting a little hands-on and understanding what we know about the rule of three, but on the bearish side. So this is really kind of a diagram breaking down on how we look psychology-wise and how we really attack kind of our bear flags. All right, so what you see here is we see play. This is a stock that makes a huge down move after market, then has a little bounce. This is what we're going to call our up one. We're always going to see the bounce. Whenever you see a hard directional move, you're going to see what we call the retrace. The retrace in this case is a pullback in play up here to the 56 level. Then we get a downward pull action. We're going to go downward towards this 54.50, right down to the support, kind of what me and John attack in our VWAP fade strategy. Then we get an up move, and then this is going to be classified up two. Up two really kind of just builds momentum towards down. We can get a down three move. Doesn't really get all the way to the support. So some people can call that one, some people won't. I can call it there because of the support line. I'll use the support line and call it holding there. And then you get that up three move, which completely rejects off of 56, which is an important key point from that up one. At the open, you get what I've seen this pattern happen a lot. When a stock is down in pre-market, you'll get the push towards the resistance. It'll complete the pattern, reverse off the resistance line, and completely come right back down through this zone. You really got to take advantage. What you want to learn is how to really watch these so that when it comes in this area, either up there at up three or here at this 4 mark, you're going to be able to take advantage and get in this trade knowing where your risk and reward levels should be. All right, so let's get into a kind of a different chart so we can really start seeing these and how we can really master the rule of three on the bear side. Okay, guys, so here we got the SPY here. You know, it doesn't only work with our small penny stocks. Here we got the SPY running on a 5-minute. What do we get, guys? We get this hard downward action at the open. Do the pen.
That was a nice one, too.
Yep. You get a hardward downward action at the open. That's what we're all going to be looking for, guys. We see the bear flag This is the flag down. Then we're going to see the bounce back. I always count these bounce back on the green bars or the move towards the resistance line. So we get a move right here. Then we get a down. We get a move right here. Starting to build that momentum. Now you can really start drawing that trend line down. And what you're looking for is accumulation at these levels. And you see the rejection clearly, just beautifully building up those important levels. Now, where do we want to be in this as a short trader? Where would we want to be, guys, if you were going to trade short? Were you guys trying to be closer to the bottom lines or to these top red points?
Top, closer to our risk.
Upward towards the resistance, clearly. Because at the end of the day, it's kind of hard on the psychological method of shorting. I remember when I first started shorting, it was kind of a little bit difficult because you have to kind of short what we call shorting into strength. When you short into weakness, it's actually what we refer to on the long side as chasing. And you can actually chase down a stock. And that's not what you want to do. Is you want to be upward towards the resistance line. So that way your risk can be in this kind of what we call the blank spot, where you can hold it off that pre-market line and you can be in no man's land where your risk is. So one of the keys is this is always going to give us an ability to master this area versus being here and not being able to risk pass up here. Because as you can see, it comes back multiple times past those levels. And if you try to get in at the bottom, you're going to get caught a lot of times just trying to see the pattern break down without seeing the rule of three happen. So the only way I recommend if you are seeing this is that after you see the three and a solid breakdown, which you see right here, and you see the volume join in, you're going to see high time and sales volume coming in right at this point. This is when I would recommend, if you do get in for breakdowns, to hit it, because now you have the volume to support it and you've seen the price action after three rejections. I like to target these at VWAP. This is probably my main target, because if I miss the first opening move because I didn't want to rush in, I like to target this one, because after I target this one and I take some profit here, all I can do is, if it doesn't get to my levels, when it gets past this little crack, I can add in this level and risk right above here. And so that's really what we're trying to tackle, guys. We're trying to tackle the psychology of seeing the kind of moves up and rejection levels. These rejection levels we use to master on the short side so that we can know where our entries should be and where our risk should be. And the really fun part is that when you start really kind of looking for these, and let's say if it's at here at 0.2, and you draw your trend line and you say, all right, well, it should kind of get in this area. You're going to see the stock down here at this level. And when it bounces, you won't get worried. You'll know that it's heading up there to that direction. And you'll be able to kind of pinpoint that spot right there at 264.20. And you can put your order out knowing that you can risk right above it. And that way, when it bounces into wicks right there, you instantly get filled and you get this kind of move. Boom. And that's what we're looking for. We're trying to master the psychology of everyone thinks that it's going to break down here, but it panics a little bit more. It gets right up to the resistance and you join in with sizing and be able to take it down. All right, let's go to another slide here so that we can break down another stock. This is the SPY. Let's break down one of the stock that we trade. All right, here's John's favorite here,
My
AMD.
baby.
That's your baby right there.
She's been doing me wrong lately, though.
Hey, it happens.
Yeah.
I mean, you had a whole week, so
Yeah.
that's how it goes. When the week either you don't put the heavy sizing, then you lay off, and then it comes back. That's how it goes.
Yeah.
So we get this down move, right, guys? All we're looking for is a bounce back. When does it bounce back? It finally bounces back here. Boom. Now we're getting that kind of downward action again. Now we want to know, all right, so we missed this spot because we were looking for the VWAP, let's say. All right, so that sounds fine. Let's see it bounce up, reject again. As soon as it rejects there, now we know that we can draw a line here. We start drawing that line and we're looking for it to bounce back to that level. And then we can either get in immediately following that one because we respected the line and know that we can risk right above here, or we let it test. It comes down and creates that support. Solid support here. Tries to break down, and this is what we call a fake out. Right here, this is what we call a fake out. It fakes out a little bit, bounces back towards what? That third point. It wants to really create the full pattern. This is the one that you can start targeting as you've drawn that line, and you can really start taking some sizing. Once you get this downward action towards the support, all we care about is can it get back above this 1950? And it won't. It hits the support, bounces up to probably about 45s, and then finally gets hit. Right here, what do you see, guys? Volume decreasing, and when it gets hit, time in sales. Watch the volume increase. This is what we're looking for. The volume increases because what happens? The breakdown happens right here, and the time in sales gets heavy, and you'll see big sellers jump in there. Boom. They knock it down, it holds resistance, and just starts making its way. And the best part is that the rule of three happens a lot, guys. It happens even here.
Yeah.
So this is something that you guys got to use more on a psychology method. If you don't use it exactly in your strategies, start looking towards a psychological method so that you can understand that after a certain amount of consolidation, especially the rule of three, we usually get those breakdowns or breakouts. Here we got one of my favorites, MBEV. MBEV, has a tendency of doing these after it breaks down. We got a little breakdown here already. We got a quick bounce right here. You get this resistance. You get a nice support hold. Just clear hold, a nice move, quick wick, right back up there. Potentials to get in, draw your line. Where your line's going to be. It's going to be right in this area. This is the area you're targeting. And you see this kind of bounce action. It holds. All you're looking for is to hold and reject here. As soon as it rejects here, you get in right here on this candle. And that way you can hold risk right above, right here. 2-cent risk and take this baby down. And then what happens? Big seller jumps in there. A big seller jumped in and knocked this thing down. It goes and it knocks through the 4 and comes down all the way to the 385s. So let's go to one more that I like here. We got MU. MU is one that has a tendency of doing this kind of green to red move or red to green move. In this case, we get that green to red move. You got that kind of trying to break out, triple tops here. Triple top. That's what we mean by a triple top when we call it out, and really gets knocked down immediately through that support. This is what we've been seeing a lot in the market. Kind of, it looks like it's going to break out, looks like it's going to continue, and then break down. And then out of nowhere, it just completely washes out. And then you get this washout. Now we get the bounce up, and we want to start really taking advantage. We want to start being, once you get that second touch, I want you guys to be able to draw out a line, because if you can draw out a line, you'll be able to be ready for the next touch. And you'll be like, all right, so then we get that down move. Okay, it comes up. I could target this one, knowing that I can risk right up here. But let's say if I didn't get into that one, I took some profit here, then I take some profit down here. Now I'm really in the comfort zone. This is when you really want to take a swing. When you get this bounce back up here in this level, and you see rejection off this green candle, in this area right here, you can take your swing, knowing that you have to, what you do when you take a swing like this is you are using your position of advantage by average cost to put yourself in a home run mode. And by putting yourself in a home run mode, yeah, your risk, let's say your average cost was right here, it might move down to this 85. But by increasing size, now you can make twice the money on the simplest of moves. 10 cents down, and you have a 20-cent move on double the size. And so you only want to do this when you know that you're shorting into the strength and can get a down move immediately right back down. And so tackling this with bigger size is what really makes those big traders out there, because they make, their 100 to 200 on this first trade. And then they use that 100 or 200 to risk it here, so that when they go and they get this down move, then they can make their $500 to $1,000. And that's called trade continuation, because it has to follow the pattern completely. But if you do get this move down here, as you can see, it follows through really well. Moving forward here, this is a move on AOBC. You see it opening hard, kind of. This is one of the most confusing candles that we get. When we get these big candles with a body right in the middle. A lot of times traders will ask us, well, what is this? This is what John and I call indecision.
Yeah, indecisiveness.
A whole bunch of indecisiveness. It doesn't really know where it wants to go. But we start getting that following move, and the following move says it starts going down. So we need to see a bounce. Finally, we see the bounce. This is when we can start attacking, because now we've seen this is going to be the down move. All right, here's the bounce. Let's start attacking. Okay, now we're going to get one washout, right? Now we understand the level, the bottom of the level. Okay, so where is it going to go to the top? Okay, well, I got this harmony. I'm going to draw from that harmony and be able to target where I want to get kind of my entries. We get this move back up. Next entry point, next potential entry point. You get a downward move again. What we're seeing is the psychology of the rejections. As the rejections get tighter, a lot of times you'll get a move right before it to the resistance, and then a quick rejection. Rejection. Now you want to see increase of volume. Decrease, increase. Why is it increase? people are adding to their position knowing that it's rejected how many times up here? 1, 2, 3, and then one final strong time trying to get through 14. Hard rejection, volume adding in for the breakdown. And people even target this last little scoop up, and it immediately gets wiped out. You get this hard move. Why? Because sellers jump in and buyers give up right here. They're done. They're done because they wanted to get out here. They got stuck. As soon as it bounces up, they're getting out. And so you'll see this on a lot of charts. It's upward, downward consolidation. And what we're trying to do is always be near the top so that we can understand the plane that kind of the stock is moving on. Once we understand the pattern, we could take advantage knowing where the risk should be and knowing where the stock should head. A lot of times when I get to these levels right here, I don't think that the stock's going to break down. I almost expect this move. And by expecting it, I could take advantage of it. I'm like, all right, well, it's just breaking down. It's just going to come down to support. It should complete the pattern, because if it doesn't complete the pattern, I don't want to trade it.
Right.
And so if it just breaks down and just, on right here, if it just does this move, and when it comes down here, it just breaks down. All right, well, so be it. I can't trade that, But when it does this complete move, this complete action, it gets more readable by the second. And after you get to that third level, a lot of traders are in by then. A lot of traders are in. You got momentum on your side. All you need is the accumulation to continue in the direction. Because if it continues in the direction, it has no choice but to break the support. And once it breaks the support, John always talks about it holding resistance. It holds resistance right here, rejects, boom. Yep. I'm sure longs covered here and immediately brought it right back down. And then when shorts saw those covers go through and the longs get out, and then big shorts start joining, everyone joined in down here.
Yep.
And that's why you get momentum. And that's what we're trying to do, is trying to better our position so that when these moments happen, it's okay to add sizing and try to take down a big stock. It would bring up a big chart here. I know Casey likes those kind of bringing up those bigger charts and they following. Here's Apple for you, doing an easy one, a down one, up one, down two, up two, down three, up three, hard rejection, seller's pressure, can't get back up there, instant return, boom, bounces one last time and rejects hard. Volume kids in here, guys. Down, down, down volume. What happens at the breakdown? Increase, spike of volume. Casey, you're watching this live. Yeah, this is kind of a perfect one. I'm sure you were seeing kind of it looking bullish at this point, at this 155.60, but then seeing it just wash out really quickly and turning around. This gives you an ability always to measure risk, guys. When you measure risk and you take rewards at the right point, you'll be able to get back into this trade. Even if you got stopped out there on this bounce back here to this resistance line, you could have got right back in it and tackled it right back down to the support.
Yep.
People don't understand a lot of times, if you get stopped out, let's say for 10 cents or 5 cents, but the way that your trading plan and the risk to reward was 3 to 1 or 4 to 1, all you need to do is focus to win on that next trade, and you'll be more than in the profit because of the way you're setting yourself up with that mathematical advantage. All right, guys, here we got another stock. We got SQ. SQ making a hard move here on a 5 minute. 5 minutes have a tendency to be a lot more cleaner with the bear flags and bear pennants. You get a quickly down move. As you see, this one just completely hold beautifully. The flag just coming right down.
Right. Very defined.
Very defined. Every single time, it just coming to that resistance line, giving you more than possibilities to come into this trade. It just keeps coming in there. And all the time, it makes moves down to the support, bounces, down to the support, bounces, down to the support, bounces, washes out. This is what I was seeing when I actually came up with the rule of three, is that I was like, well, I mean, if it's going to consistently do those bounces, we have to have some way of taking advantage. And that's what I came up with, is taking advantage of shorting into the strength, or let's say longing into the weakness.
Follow through, man. These look really tempting to want to trade.
So what can we learn here? The rule of three exists in either trade direction. We got to use important levels to complete our trade plan. Stick to those levels, as they are what traders are watching. So watch those level 2 in the time and sales. It's important to learn to read the tape near the important levels to see the rejections or the accumulation of volume. And always stick to a risk and reward to maximize on your potential gains. The rule of three, I see time in and time out in the market. You have to be ready for it, draw it out, know how to take the trade, don't hesitate, know your risk and reward, and tackle that target. So like always, guys, if you like this class and you want to go ahead and see more, click the description below, hit the subscribe, hit the like for us. We're going to go ahead and continue putting out all free content. This is absolutely free, our complete course, and that's exactly what we want to do, is just continue being 100% free and transparent to other traders so they can go ahead and learn without paying thousands of dollars. And if you want to trade with the broker that John and I trade every single morning, don't forget, click the description below. For as little as $400, you can get an intro account, giving you $14,000 in buying power, an incredible list to short, and of course, shorting IPOs like Chewy right now and CRW, Counter-Strike. These stocks available to trade on TEFs. Don't forget, click the description below, hit the like, guys. Like always, beginner in, beginner out, guys.